Hello there. This part of Lecture Series 20 focuses on the underlying principles of lessor accounting set out in IFRS 16 Leases. IFRS 16 stipulates that a lessor shall classify each of its leases as either a finance lease or an operating lease. A finance lease is a lease that transfers substantially all the risks and rewards incidental to ownership of the underlying asset to the lessee. On the other hand, an operating lease is a lease that does not meet the definition of a finance lease. In assessing if a lease is a finance lease, it depends on the substance of the transaction rather than the form of the contract. IFRS 16 states a lease is probably a finance lease if either individually or in combination the following apply. 1. The lease transfers ownership of the leased asset to the lessee at the end of the lease term. 2. The lessee has the option to purchase the leased asset at a price expected to be sufficiently lower than the fair value at the date the option becomes exercisable, and it is reasonably certain at inception date the option will be exercised. 3. The lease term, including secondary periods if any, is for a major part of the economic life of the leased asset. 4. At inception date, the present value of lease payments amounts to substantially all of the fair value of the leased asset. 5. The leased asset is of a specialized nature that only the lessee can use it without making major modifications. 6. The lessee will compensate the lessor for their losses if the lease is cancelled. 7. Gains or losses from fluctuation in the fair value of the residual fall with the lessee, for example, by way of a rebate of lease payments. 8. The lessee has the ability to continue the lease for a secondary period for substantially lower than market rent. At inception of a lease, the lessor shall recognize assets held under a finance lease in the statement of financial position and present them as a receivable at an amount equal to the net investment in lease. The lessor shall use the interest rate implicit in the lease to measure the net investment in lease. The interest rate implicit in the lease is defined as such that any initial direct costs are included automatically in the net investment in lease. Lease payments included in the measurement of net investment in lease comprise the following. 1. Fixed payments less any lease incentives payable. 2. Variable lease payments that depend on an index or a rate initially measured using the index or rate at commencement date. 3. Amounts expected to be payable by the lessee under residual value guarantees. 4. If the lessee is reasonably certain to exercise the option to purchase the asset, then the exercise price of the option shall be included. 5. Termination penalties if the lease term reflects the expectation that these will be incurred. Important to note, the unguaranteed residual value is excluded from lease payments but is factored into net investment in lease. It represents the sum that the lessor expects to recover from the value of the underlying asset at the lease conclusion that is not assured or guaranteed. On subsequent measurement, the carrying amount of the lease receivable is increased by the interest income and reduced by the cash receipt. The final part of Lecture Series 20 on IFRS 16 will focus on operating lease, presentation and disclosure in the financial statements of lessor, as well as sale and leaseback.